Hi friends, welcome to NISHCHAY series. In NISHCHAY series, as you know, we are covering MCQs, case studies, objective questions of all the subjects. I am covering BFM and ABM. Others are covering means other topics as well. Okay, BRBL, ABFM. Okay, so follow this series till the end. We are covering all the important repeated MCQs and case studies. Repeated ones. So that's why follow this series completely, share it with your friends, like this video, subscribe to the channel. Okay, so let's move on. First question. Which of the following statement is not correct regarding floating provisions? Floating provisions. Okay, which of them is not correct regarding floating provisions? These provisions can be netted off from gross NPS to arrive at a disclosure of net NPS. These provisions can be treated as a part of Tier 2 capital with an overall ceiling of 125% of the risk-weighted assets. These provisions can be reversed to credit to P&L account at the discretion of the bank and none of the above. So which of them is true? Think. Think about it. Floating provisions. What do you mean by floating provisions? Everyone, what do you mean by floating provisions? Yeah. Okay. So you want not correct. Huh? Kindly look at it. You want not correct. Which of them is not correct? Okay. So first let's see what is correct. Which one is correct over here? These provisions can be netted off from gross NPS to arrive at a disclosure of net NPS. So gross NPA netted off from gross NPS. Whatever can be netted off means subtracted, removed from the net gross NPS to arrive at the net NPS. True. These provisions can be treated as a part of Tier 2 capital with an overall ceiling of, I think 1.25 it is, 1.25% of the risk-weighted asset. That is also true. These provisions can be reversed to credit to P&L account at the discretion of the bank. This is wrong. False. Because these cannot be reversed or at the discretion of the bank. It's not at the discretion of the bank. If you have excess provisions, here what is floating provision basically? The provisions which we make for the loans. Okay. Now if these provisions are in excess, then you can reverse this, that also not to Tier 2 capital, Tier 1 capital, it can be reversed to Tier 2 capital. Okay. So the correct answer means which one is not correct is this. At the discretion of the bank is wrong. Okay. Next. A doubtful asset for more than 2 years account has a balance of rupees 7 lakhs with a security of 5 lakhs. The account has CGTM SE guarantee of 75%. What is the amount of provision? So doubtful asset for more than 2 years. So doubtful for more than 2 years. So it is in which category? Doubtful 1 is for 1 year. Then doubtful 2 starts. So this will be in doubtful 2 category, D2. So it's in D2 category, D2. What is the provision for D2? What is the provision for D2? It is 40-100. 40-100. 40% for secured, 100% for unsecured. So this is in D2 category, right? Now the loan is what? 7 lakhs. What is the security? 5 lakhs. So subtract this. From this 7 lakhs, 5 lakhs is under secured and 2 lakhs is under unsecured. 5 lakhs is under secured, 2 lakhs is under unsecured. Now, this 5 lakhs is secured. So, what is the provision for this 5 lakhs? For this 5 lakhs. So, it is 40%. 5 lakhs into 40%. 5 for the 20, 2 lakhs. So, provision is 2 lakhs. Provision. Okay. Provision. 2 lakhs provision for this secured. What about this unsecured? See here, 75% is CGTMSE cover. Now, this cover will not be applicable to the secured part. Kindly note, this is the insurance, as good as simple insurance. It's a central government scheme for MSMEs. This is the same scheme which covers Mudra loans also. Mudra loans are also covered under this scheme only, CGTM-SE. Okay. So, this is not applicable for secured loan, secured part. It is applicable for unsecured part. So, now this unsecured part, 75% is secured by this CGTM-SE. So, now this 75%, 2 lakhs into 75%, 0.75. So, what is the answer for this? 2 lakhs into 0.75, 75 to the 150. So, 1.5 lakhs. 1.5 lakhs is secured. That is secured by CGTMSE. How much is the remaining? 0.5, 50,000. So, 50,000 is your remaining part. This 50,000, okay, is the remaining part. So, this 50,000, you will have to make the provision because it's 100%. So, complete 100%, you will have to make the provision of this. So, it will be 50,000 plus 2 lakhs, 2 lakh 50,000. 2 lakh 50,000. Okay. Getting this? Check this, everyone. So, the answer over here should be 2.5 lakhs, not 4 lakhs. Okay. So, this will be the answer A, 2.5 lakhs. Got it? Always remember, see this, total loan 7 lakhs. Out of the 7 lakhs, what is the secured part? 5 lakhs. So, 5 lakhs is gone, 5 lakhs. So, in this 5 lakhs, what is the provision? 5 lakhs into secured part is 40%. So, 5 lakhs into 40%. So, 5 into 4, 20, 2 lakhs. What is the unsecured part? 2 lakhs. 7 lakh minus 5 lakhs, 2 lakhs. This 2 lakhs into 75% is covered by CGTMSE. We see this 75%. So, this 75% is covered. 2 lakhs into 75%. So, it is 1.5 lakhs. 1.5 lakhs is covered by the insurance. So, how much is uninsured? 50,000. So, this 50,000 will have complete 100% this provision. So, 2 lakh plus 50,000, it will be 2 lakh 50,000. So, that is the answer. Okay, 2 lakh 50,000. Okay, next one. Which of the following is a potential internal factor that may lead to liquidity problems in the bank? Think, everyone. Internal factor, internal, okay, which will lead to the liquidity risk in the problems in the banking. External economic shocks, here focus on internal factor. External economic shocks, decreasing depositors' trust in the banking sector, depositors' trust, very sensitive financial markets and non-economic factors. So, which of them are the internal factors? Internal. So, which are internal over here? Here, economic shocks. This is external factor. So, you want internal. So, this is E, external. Very sensitive financial markets, external, E. Non-economic factors, E. Only this depositor's trust is the main problem internally. If that is gone, then the bank is in the trouble. Okay. So the answer over here is this. Decreasing depositor's trust. There is an excess provision on account of sale of some NPA accounts. So sale, excess provision on account of sale of NPA with the bank. The excess amount of the provision shall be. So what should I do with this excess provision? I have sold the NPAs. Now what should I do with this excess provision which I have made? Means I had made the provision for the NPAs, but now what has happened? These NPAs are sold. So as the NPAs are sold, so what do I do with that provision amount? Because that is basically locking my money. So in that case, what do I do? It will be credited to P&L account, taken towards the part of tier 2 capital, taken towards reduction in provision of NPA accounts, deducted from gross NPA to reach the net level. What do I do with these provisions? Think everyone. Check the answer. Just now in the first question I told you, first question, how this excess provision is adjusted, or floating provision was a question over there. How is it adjusted? It is adjusted using, it is converted or returned back to which one? Tier 2. That is the answer. Okay, it's taken towards part of tier 2 capital. So this is reversed back to part of tier 2 capital. This is the answer. It is taken towards the part of tier 2 capital. Okay. Why tier 2 capital? Now, why this here? Why this answer? Why not this? Why not this? And why only tier 2? Why not tier 1? Because look at this, provision means what? Provision is the amount which you have kept it separate. Okay, why did you keep it separate? Because there was a loss, expected loss in the business. Expected NPAs. So this doesn't become the free capital. This becomes the compulsory capital. It's a compulsory provision. So anything which is not free will be transferred to tier 2 capital. Okay. Under which method of value at risk calculation? VR is calculated using sample of randomly generated price scenarios. Randomly generated price scenarios. Is it under correlation method? Is it under historical simulation method? Is it under Monte Carlo simulation method? Or is it under back testing? Now, firstly, understand what are these methods. Correlation. What is this correlation method? Correlation method means the correlation is done between the repo rates or the interest rates with the other factors. Other factors means it can be your GDP, it can be your inflation, it can be anything. So that is correlation. Here we relate one factor with one at one time. So various correlations can be there. Historical simulation method. Now see this. Randomly generated price scenarios means what? This is what are you saying? Scenarios. What do you mean by scenario? Future. You are talking of if this happens, then what? If this happens, then what? What is this actually? Whenever I am talking of future scenarios, is it historical method then? In history, do you see what is going to be the future? In history, we look at the backside, reverse. So historical simulation method is basically, it can be called as this backtesting and historical simulation. Roughly, they are related. Based on the history, what all was the data from my last 20 years, 30 years, that data I am taking and doing the simulation. Backtesting. What is backtesting? Backtesting means again the same. I am taking the data for last 10 years, okay, and based on that data, I am predicting the future. But there is no randomly generated. Randomly generated is over here, Monte Carlo. Monte Carlo simulation is the best method for the futuristic calculations. Basically, this is used in stress testing. Stress testing, we use Monte Carlo simulation. There are two methods, right, for calculating VAR. One is stress testing, second is back testing. So here we are calculating Monte Carlo simulation. Means what? You consider one scenario, then you filter various points and go on filtering. Means what? Let's explain this in 1 minute. Suppose if I want to study something, what will I do? I'll have a meeting, first meeting with some senior guys. In this meeting, let's say I'll discuss 10 points. 10 points. From these 10 points, I'll filter 5 points. Then in meeting 2, I'll discuss only these 5 points. From these 5 points, I'll again filter 1 or 2 points, 2 points. So last meeting, meeting 3, with all the seniors, what will I do? I'll discuss these 2 points, and out of that, I'll come up with a single solution. Single. Okay. So that is Monte Carlo simulation. That is Monte Carlo simulation. Kindly note. In Monte Carlo simulation, you go on filtering the points. Okay, filtering, more and more filtering. So that refinement is done and you come up to the single solution. Got it? That is the meaning of Monte Carlo. This is similar to one technique that is called as Delphi technique. Monte Carlo and Delphi are similar. You check it out, check out on Google. Delphi technique, roughly similar. Okay? Next one. Provision coverage ratio is to be calculated as, what is PCR? Provision coverage ratio means this is called as PCR. RBI gives you that it should be 70%. Is it written somewhere? No. RBI says that PCR should be 70% of your earlier NPAs, gross NPAs. 70%. That's what is the RBI circular. Now let's look at the question. Provisioning coverage ratio is to be calculated. Total provisions including standard accounts, net NPAs of the bank, including standard accounts, net NPAs. Total provisions including standard accounts, gross NPAs. Provisions and net NPA of the bank. Provisions and net NPA of the bank. Provisions and gross NPA of the bank. So now think. Mainly remember it's for gross NPAs. It's never calculated for net NPAs. So 2 answers are gone, right? So which one is correct then? 2 are gone. Which 2 are gone? A and C are gone. A and C, right? Because net NPA is not the answer. Kindly remember, for PCR, net NPA is not the answer. So these 2 are gone. Now only answer remains is between B and D. So in B, standard accounts, do you take PCR? In PCR, do you take standard accounts? You don't take. Provision is always for the NPAs, gross NPA. So this is the answer. Okay? This is the answer. Got it? Which of the following are the objectives using derivative products by the treasury? Using, here, why do I use derivatives? To manage liquidity ALM risk, to meet the requirements of the corporate customers, to trade in currency and rupee derivatives, all of the above. So why does the bank treasury use derivatives? Why does it use? Yes, the answer is, why does the bank treasury use derivatives? The answer is all of the above. Here, manage liquidity ALM risk. Liquidity and ALM. How do you manage ALM in liquidity using derivatives? Here, kindly note, whenever you buy some asset or let's say you buy some bond, there are chances that the bond might go down also. The price of the bond might go down. So whenever you buy anything, buy first, buy at low rate. And then when the rate goes higher, sell at high rate, sell high. This is the general principle followed by the banks, anyone in the business. But if there is a problem, let's say, there is a problem in this, the rate goes below your rate, then what? Then you will face a problem. You will face a loss. If the rate goes below your rate, then you will face a loss. In that case, what do you do? So this is known as commodity position. Commodity. Whenever you buy any share, any bond, any gold, that is called as commodity. And this is known as long position, long. So this is known as long. Long. Whenever you are long on any commodity, which derivative should you buy? You should buy a put option. Options, you should buy a put option. Put. Buy a put option. Okay? This is known as commodity position. This is known as derivative position. Okay, you should always buy a put option. Got it? Now similarly, if I am doing a reverse transaction, means I am selling first. Here, first buying, then selling. Long. I am doing a reverse transaction now. In that, I sell high first. Here, I will always sell high only. I will sell high first. See, selling is first and buying is later. And when the rate goes down, I will buy it. Buy low. This is known as, this position is known as short position, short. Whenever you have a short position on commodity, you should buy a call option. So you should buy is call. Call. Okay. So you should buy a call option over here. Kindly note this. And this is made by managing the liquidity and ALM risk. If the price of that commodity, whatever you have bought, you might buy gold, you might buy shares, you might buy bonds, you might buy forex, dollar. So anything you can buy. But if the price goes down, then the options will give you the support. Okay. So that's why this derivative option is a derivative to meet the requirements of the corporate clients. So here also, meet the requirements of the corporate clients. So this is correct. Corporate clients also, see here, as you require to safeguard your position using derivatives, options, similarly clients also require the same. So they will buy the options through you. That's it. You are an agent over there. You will get a commission, isn't it? To trade in currency and rupee derivatives. This is known as proprietary position. Proprietary. See here, just now I gave you that position, first one. I have purchased the commodity and to counter it or to hedge that risk, I am purchasing the derivative. This is exactly opposite. Here what am I doing? I have not purchased the commodity at all. I have not purchased gold. I have not purchased dollar. I have not purchased anything. I am just purchasing options. That's it. Why? Because I know this put option, right now if I buy it at, see, there is a price involved in everything. If I buy the put option at, let's say, 100 rupees, I know this put option market is going down. So put options price will go from 100 to 300. So I learn in this. This is known as proprietary position. In proprietary position, I don't hedge the risk. I try to earn the profits. Okay. Kindly remember, you can buy the options, you can sell the options, derivatives. You can buy the derivatives, you can sell the derivatives. Selling is called as writing the derivatives. Writer it is called as. Okay. So all the three are the answers. Okay. Which of the following options are available to the banks for managing interest rate risk? Managing interest rate risk. Interest rate. What is interest rate risk? Interest rate means take simple repo rate. Means there can be many interest rates. I'm just giving one example, repo. It can be repo rate. So, if the repo rate goes down, what happens? Many changes happen. Your loan rates will go down, your deposit rates will go down, your NII will be affected. So, after all, your NII affected means what? Your spread is affected, means your income is affected. So, how to counter that? How to hedge that? Match the long-term asset preferably with non-interest bearing liabilities. Long-term assets. See, this is the part of your module D. Match the long-term assets preferably with non-interest bearing liabilities. Match the repricable assets with similar repricable liabilities. Use forward rate agreements, FRAs, swaps, options and financial futures to construct synthetic securities. What is synthetic securities? And does hedge against any exposure to the interest rate risk. Only A and B, only B and C, only A and C, all A, B and C. Whenever we get such option, generally we tend to write, this, simple, all. Remember, every time the answer will not be all. This time it is all. Every time it may not be all. Okay? What is it but? What do you mean by this? Synthetic securities. What is a synthetic security? Synthetic means I combine the derivatives. I combine the derivatives. Means what? I'll combine the swap with options. These two I'll combine. So synthetic, I'm creating something. Okay? Or I'll combine these options with financial futures. So two derivatives or two products are combined to form a third product. This is known as synthetic securities. Okay? So I can use these synthetic securities also. Matching repriceable assets with repriceable liabilities. That is also true. Repriceable assets means what? What are repriceable assets? Let's write down. Assets. What are the repriceable assets? Loans. All the loans. Term loan, CC. These are repriceable. Why? Because what do you mean by this word repriceable? Where the rate of interest will change. Okay. So term loan, CC plus any bonds which you have purchased. Bonds. Okay, bonds. Purchased, right? Kindly remember. That is only asset. Purchased. What are liabilities? Repriceable liabilities. Liabilities. Okay? What are these repriceable liabilities? These are liabilities, saving, FD. Why? Because they are bearing interest. Plus bonds issued. Bonds, kindly note. That's why I said over here. Purchased. This is issued. Okay, bonds issued. These are all repriceable liabilities. So which are not? Which of them are not repriceable assets and repriceable liabilities? Cash. Cash is not a repriceable asset because cash doesn't change. If I am having 100 rupees in my pocket, even after 10 years I will be having 100 only. Will it grow? No. What is repriceable liabilities? Current account. No interest. So repriceable liability. Okay. So match repriceable assets with repriceable liabilities. Match the long-term assets, preferably with non-interest bearing liabilities. That is also right strategy. Long-term assets. What do you mean by long-term assets? See these. Bonds which are of more than 10 years or loans which have been given for more than 10 years is not allowed. Let's say sometimes we allow 15 years also, depending on the permission. So match these long-term assets with non-interest bearing liabilities. Non-interest bearing means non-interest bearing liabilities. Means those liabilities which are not having the interest, current account. Okay, match them with these current accounts. Got it? Clear? If recovery is received in an NPA account, it is to be appropriated as under. So it is, if recovery is received in an NPA account, it is to be appropriated as under. First to the principal amount, first to the interest amount, as per the formal agreement between the borrower, and if there is no arrangement, at the bank's discretion, which should be the rule for all the accounts, and at the discretion of the bank. So now kindly note this, if recovery is received in an NPA account, how will you manage this? Many of us will think in this direction, this, okay? Will think in this direction. Either to principal, somebody will say interest first, interest first, interest. Interest is the income, so first interest. Somebody will say no, principal is main, principal. But the real answer is this. As per the formal arrangement with the borrower, whatever has been agreed with the borrower. Okay? And if there is no arrangement, then bank will decide. Bank's discretion. Okay? Got it? This is very important because many of us think this answer, interest. It's not. It's as per the arrangement with the borrower. Okay? Chalo. Now before going, everyone kindly note, kindly join the batches. The new batches have just now come in. Okay? Selection Pro batches. For this, go to Adda 24/7. I'll always suggest you to go through the app. In the app, you are getting 1% extra using the coin systems. So you always use the app for joining the batches. Okay? Go to Adda 24/7. Click on JIB and CIB. Look at this. Click on JIB and CIB. Click on CIB June. See these batches. Selection Pro batch. English. Join this English batch. Okay, join this English batch. Selection Pro. So click on this. In this batch, see here, just now it has started. We are covering all the numericals, objective questions, case studies, everything. Okay, so join this SN. Ebooks are available, test series are available, recorded videos are available. So if you find any, if you miss out any class, you can go through the recorded videos as well. Okay? Use the code Y432. Kindly note, use the code Y432. Y432. Okay? Click on enter. Got it? See this. 80% discount plus 1% extra through the app. Never forget this code Y432. Also you can join the Mahapack. See this. CAIB Mahapack. You can join this Mahapack also. Mahapack 2.0. In this Mahapack you are getting right now double validity. Plus in Mahapack you are getting 15 plus batches. 15 plus per subject. So join this Mahapack. 6 plus 6 months. You buy for 6 months, you get it for 12 months. Okay? Again, code is same Y432 and double validity plus 81%.